You know, if you put an exchange-traded fund and an index fund side by side, you'd probably think they're financial twins. I mean, they often track the very same stocks, so they seem totally interchangeable, right? But there's this one tiny difference hiding under the surface, a detail that could be quietly draining thousands of dollars from your returns over time. And what's so wild is how subtle this is. We're not talking about some big, glaring fee that pops up on your statement. Nope. This is something much sneakier, a cost that's literally built into the DNA of the product. It's like a little financial puzzle, and we're going to solve it together. So that really is the million-dollar question, isn't it? If they look the same and act so much alike, where's this hidden cost even coming from? What's the one thing that really sets these two investment giants apart? Well, to get our heads around this, let's use a simple analogy.
Okay, so think of it like this: a slow-cooked meal versus a fast sports car. Now, this comparison really gets to the heart of the philosophy behind each one. It's not about which is better, but about understanding what they're actually built to do.
First up, let's picture the index fund. It's that slow-cooked meal. You prep the ingredients, you set the timer, and you just walk away. It is designed for one thing and one thing only: to be steady, automated, and completely hands-off. The ETF, though, that is the flashy sports car. It's slick, it's fast, and it gives you this incredible minute-by-minute control. But, as you know, with all that power comes some potential danger. You're the one in the driver's seat.
So, how does this slow meal and fast car thing actually play out in the world of investing? All right, now we're going to get into the mechanics. This is where we pull back the first curtain on that hidden cost, a small but very real trading tool. So our slow-cooked meal, the index fund, works on something called net asset value, or NAV. Because it's designed to be a set-it-and-forget-it kind of deal, all the buying and selling gets bundled up and priced just once, after the market is already closed for the day. One price, once a day. That's it. It's predictable by design. Now, this is totally different from our fast car. ETFs do not wait for the end of the day. Their price is bouncing around all day long, second by second, just like an individual stock. You can buy at 10:15 in the morning, sell at 1:30 in the afternoon, and the price will probably be different every single time. This is what gives you that feeling of being in total control. I mean, that sounds like a good thing, doesn't it? More control, more flexibility. What could possibly be the downside to that? Well, it turns out that variability to jump in and out of the market whenever you want is exactly what exposes you to a specific and often completely overlooked fee. And it's called the bid-ask spread. Basically, for anything that trades all day long, there are always two prices happening at the same time. The bid is the most a buyer is willing to pay. The ask is the least a seller is willing to take. And the ask is always just a tiny bit higher. That tiny little gap, that's the dealer's cut. It's a small toll you pay every single time you make a trade. Since index funds only price once, you don't really deal with this. With ETFs, it's there on every trade.
But here's where the story really takes a sharp turn. That bid-ask spread, it's real, for sure, but it is not the biggest hidden cost, not even close. The real story, the biggest cost of all, has almost nothing to do with the market and everything to do with us, with human psychology. Let's go back to our sports car analogy. The biggest risk of owning a supercar isn't the cost of insurance or gas. It's the constant, nagging temptation to just floor it, to weave through traffic, to push it to the limit just because you can. The car itself isn't the problem. It's the freedom it gives you to drive recklessly that creates all the risk. I just want you to look at this number for a second. 1.5%. In the investing world, where tiny fractions of a percent can compound into a fortune over decades, this is an absolutely massive number. So what in the world does it represent? That 1.5%, that's the average performance gap between investors who trade all the time, which ETFs make super easy to do, and the investors who just buy and patiently hold for the long run. Giving people that sports car tempts them to trade more often, and on average, all that extra trading just leads to way worse results, year after year. And honestly, it all comes down to this one simple idea. You can have the most mathematically perfect investment in the world, but if its design encourages bad behavior, like panic selling when the market drops, or chasing some hot new trend, then all that perfect math just goes right out the window. Our own impulses end up being the biggest cost of all. Okay, so let's tie all of this together. We started with what looked like a simple question, we dug into the mechanics of the market, and we ended up with a really deep insight about human behavior. So what's the big takeaway here? What does this actually mean for you? Remember, we started with a myth that ETFs and index funds are basically the same thing, Then we peeled back a layer and found the technical reality, that ETFs have those small but real trading costs from the bid-ask spread. But the most important thing we found was the human reality. The very freedom and control that makes ETFs so attractive is often their biggest weakness, because it tempts us to act in ways that actually hurt our own results.
So I'll just leave you with this one question to chew on. We're always told that having more options and more control is a good thing. But as we've just seen, maybe, just maybe, the smartest move is to intentionally give up some of that control, to choose the slow-cooked meal over the flashy sports car, because in the long run, it's patience, not speed, that usually wins the race.